Hello and welcome to Bondcast, our podcast series where we discuss the latest themes and events shaping rates markets. I'm Joann Spadigam, European rate strategist, and I'm joined today by Kevin Cummins, our US economist.
Hey, Joann. We're just fresh out of the ECB meeting, which they delivered a 25 basis point cut. The press conference just ended, and I was wondering what your key takeaways are from the policy statement and the ECB forecast.
So, a fairly interesting message in the sense that when describing the inflation outlook, the ECB did say things like they thought that there was a market improvement in the inflation picture. Obviously, underlying inflation is coming down. Many of the other measures that they watch are also coming down. But there has been a bit of stickiness in services and wage inflation data, as we all know. So with that, they had also revised upwards their inflation projections for 2024. Which we hadn't expected. We did expect that would be in line with that previous inflation forecast. So I think on balance, they seem to deliver a 25 basis point cut with a slightly hawkish message in terms of the inflation forecast, which they did see to be higher than previously. So I think that on balance, it was a mixed message, and it did, I think, moderate how dovish the cut could be, all things considered. I think the press conference was also quite balanced, lots of data dependence being mentioned, and not really too much for the markets to take away, I think, from today's messaging for the future path of policy rates, really.
Yeah, and just to follow up, I guess, on that, what has the ECB said about the path forward for rates? And then I guess in two-pronged in that, have you shifted? Has that changed your view about the path forward for rates?
So Lagarde was asked a few times on the path forward for rates, and I think they essentially didn't want to answer that question. She was asked whether forecast meetings would be more important than non-forecast meetings. She just said that, they do get more data, they get the inflation projections, so there is more analysis done in those meetings, but that doesn't mean that they don't cut necessarily at non-forecast meetings. So they really have avoided tying their hands to a specific policy reaction function. They have noted that there are three key points or elements for the markets to watch are inflation, underlying inflation, and monetary policy transmission. So the three criteria that they've continued to mention for quite some time. But they really did avoid giving much away. I do think that what we have gotten from the fact that they have increased their inflation forecast for the year is that it will be quite unlikely for us to get a cut in July. They didn't say explicitly so, but I did think that messaging suggested that they may not be cutting in July. But I think that in terms of overall easing for the year, our 75 basis points cut for the whole cut for the year still remains very much intact. And I do think that is likely to happen based on the data and based on the fact that I think that if they skip September, what they've essentially shown us is that there is a policy mistake of sorts, because I think that, inflation is moderating. They do see inflation gradually normalizing. The inflation projections for 2026 continues to be 1.9, and I think it deviates very little meeting for meeting. So medium-term inflation is at target, and they do expect that underlying inflation pressures are moderating. So I do think it's still consistent with a continuous cutting cycle through this year and 75 basis points in total. I think it doesn't really change very much for what we think, given that we also thought that July was a skip. But I do think the inflation projections have added to that conviction for the euro area. So, a fairly uneventful ECB, as I've just mentioned, and not too much, I think, for markets to take away. We're still waiting and seeing what the data holds to really come up with a path for rates going forward. But hopefully the Fed next week will give us some more to think about, Kevin. We've got the FOMC next week. What do we expect there?
Well, it'll be an end of quarter meeting, obviously, and these are the ones where not only will they determine, the views on interest rates at that meeting, a decision, but also we'll get updated forecasts on economic growth and inflation. And of course, the dot plot that'll show participants' expectations for the year-end Fed funds forecasts with the appropriate policy that they expect. So there'll be a lot to digest. We'll have a press conference 30 minutes after we get all that information at 2 o'clock Eastern Standard Time, and then Chair Powell will begin his press conference at 2:30. So, it's widely anticipated the Fed's going to be on hold now. The inflation backdrop, as we've talked about several times and everybody is keenly aware of, has been uncooperative from the Fed's perspective. Coming into the year, everybody thought the Fed would start easing by now. The inflation re-acceleration in the first quarter this year really have put expectations on the shelf for a while. So I think similar to the ECB, from the perspective of really gaining too much information, it's right now it's probably too early. It'll be really data dependent. But it's universally expected that there's not going to be any change in policy next week. But the updated dot plot, I think, by itself will probably be slightly hawkish in that, the last time they updated this in March, the Fed base case of the median dot showed 3 cuts this year in the funds rate by year end. And another 3 in 25, and then another 3 in 26. And I think what we're going to see now is kind of shifting out in those expectations among policymakers. So, the debate is whether or not they go to 2 cuts by the end of this year or 1 cut. Our own forecast for the Fed is that they only have 1 cut this year. But I'd say the risk is closer to 2 cuts rather than no cuts. But as far as the Fed's forecast, I think that we're going to see next week, I think it's pretty safe to assume that you're going to allow some optionality there. So rather than really going just to our forecast of only 1 cut, I think the Fed's going to find kind of a happy median of showing 2 cuts by the end of the year. This way, it allows them the optionality of going as early as July if they really seem fit. Right now, the data that they've seen and what we're going to see ahead of the meeting, potentially on employment, because this is recorded prior to the May jobs report, and then the CPI report for May as well will be released on the day of the meeting. So, that isn't going to change the outcome of the report, but it could change the tone that Chair Powell will use. And, depending upon on the results of those 2 reports, we could see a little bit of shifting in the dots. But I still think that the outcome from this dot plot is going to show 2 dots of easing this year. It just seems like they probably don't want to go out on a limb and emphasize that rate cuts aren't going to happen. I think Powell's base case is that they could go once or twice, but it'll be data dependent. I think that's the emphasis he'll highlight in the press conference. So there'll be a lot to digest on the economic projections. The Fed came out with a very optimistic outlook on growth this year. It's not too surprising given that the economy in the U.S. has been very resilient through 23 and early 24. But we've had some more mixed data recently, some evidence of some slowing. Whether or not we're going to get our forecast where growth kind of stagnates later this year, or the Fed's forecast where things just keep moving along just a bit at a slower pace than what we saw last year, GDP growth above 3%. This year, the Fed, as of March, had 2.1% GDP growth this year. I do think, given that top line GDP in the first quarter, not that it was a bad report, because under the hood, the domestic demand really held up pretty well, close to a little bit below 3% after we saw last week's revisions. But top line GDP only was up 1.3%. So that calculation of calculating a Q4 over Q4 basis for this year, which they showed at 2.1, and some more evidence of some slowing in the overall pace of growth more recently, probably requires the Fed to mark those numbers down. So we could see something in the neighborhood of about 1.75% from the Fed. We'll see, of course, Friday's jobs report. That I think will have an important implication just for the overall takeaway on the growth and the labor side. With regard to the unemployment rate, officials expected about 4% by the end of this year. Again, we'll see where May comes in, so they'll probably be influenced by the May report. But I wouldn't doubt that probably nudges up a little bit higher, maybe just above 4%. And then, of course, if they're delaying their expected rate cuts, from 3 to 2, they're probably going to need to revise up their inflation forecast. So I would think that the core PCE price index, which as of March was estimated by the Fed to be up 2.6%, probably nudges a little bit up to around 2.8% or so. So, that would be consistent with the idea that they haven't seen sufficient enough evidence that inflation is getting back down to 2% before they can start to cut rates. So I would think that, that would be a reasonable set of assumptions for Fed officials to think by year end, if we're looking at maybe 2 cuts, that, a little bit softer GDP growth in the first quarter probably takes a little of the steam out of their 2.1% estimate from March. And then the inflation backdrop, for the first 4 months of this year, core PCE prices were up at a 4.1% annualized rate. So it's going in the wrong direction for them, that they'll probably nudge that year-end number up to about 2.8% or so. Our own forecast on that is only 2.6%, which is their forecast for March. But we're a little bit more optimistic, I think, than the Fed is on the inflation backdrop, but a little more pessimistic on the growth side. So, our forecast is, as I've mentioned, only 1 cut this year, but, it'll ultimately come down to the data. The one other thing I'd say is markets will pay attention to, and I think this is really hard to handicap going into a Fed meeting, of how much that longer run dot can actually move up. But I do think we could see another nudge up. Certainly, that's the direction of travel that this is going to go, that I think ultimately you'll probably see a number. Now, I'm not saying next week, of the Fed's long run dot moving up to 3.25, maybe as high as 3.5. But we'll probably see, if we see anything, a very modest increase next week. But that's not assured. There are 19 officials, and it's really hard to say who's going to, change their dot at any particular meeting. The one caveat I'd say that I would think there'd be a little bit more risk at this meeting is, so there's 19 participants in the meeting. Former St. Louis Fed President Bullard never submitted a longer run dot. So there were only 18 long run dots. Now, he's since moved on from the St. Louis Fed, and we have a new president that took office, I believe, a couple months back in March or April. So he'll have the opportunity, if he chooses to include a long run dot. And presumably, Bullard was one of the more hawkish members of the committee at the time of his departure. So I would think that it probably makes sense that the new president probably, he's got the same research director, and he's hearing from the same experts at the St. Louis Fed, giving him guidance on expectations. Now, he can obviously have his own view, but even if he goes into that median dot of 2.6% or so right now, that'll probably shift up that longer run dot a little bit, nudge it up. So I wouldn't be surprised to see that move up a little bit at next week's meeting, even if everybody else submitted the same dots, if we get that dot. So there's a lot of uncertainty there, but it is interesting to see, if that does move up, is it just simply because the St. Louis Fed is now including their dot? He kind of breaks from Bullard's tradition of not including a long run dot. Outside of that, changes to the statement itself are probably pretty modest. I would imagine, given the little bit more of mixed data, the characterization on economic activity, rather than saying that it's necessarily slowing, because we don't really know what the outcome of the employment report is. And I think that'll have an important role on kind of the takeaway of the most recent data. They could just put it into some sort of past tense about having, economic activity has been solid or something like that. Because last time around they said, economic activity continues to grow at a solid pace. So rather than saying it continues, they could probably put it, in saying has been solid. And this way they kind of avoid adding too much, given the level of uncertainty about how much slowing the economy is right now. As I mentioned, the jobs and the CPI data probably will, if they're different than expectations, may require a little bit of tweaking in the current conditions paragraph. But the forward guidance probably is going to be identical to what it was on May 1st when they submitted their last statement. And then they'll probably drop a lot of the language around with regard to the balance sheet, and just say that their earlier announced intentions as of earlier this month is progressing or something along those lines, given the fact that it's kind of running on in the background now and not so much a new announcement expected for a while. So that's really it from the statement, from the dots, from the summary of economic projections. And I think Powell will, won't probably unveil all that much new guidance necessarily. So unlike the dot plot, which may be fairly hawkish relative to the September plot, which showed a little bit more easing sooner, is probably not really going to have all that difference of a tone than he did at the May meeting. We just didn't have an update for the dot plot at that meeting. It was the last one was done, obviously, at the end of the first quarter at the March meeting. So those are really the key takeaways from the Fed that I expect next week.
So if we do get what you've described just now, Kevin, how does that impact your expectation for rates for the rest of the year?
Yeah, so I think it's very much data dependent. So even if you saw the Fed is nudging up their estimates of long run rates, I think Powell's going to emphasize that policy is restrictive now. It's a question of how restrictive they are, but I think a more neutral rate of say 3 or 3.25 or even 3.5%. Right now rates are 5.25 to 5.5%. So they've got a lot of wood to chop to get back down to a more neutral level. And I think right now they're trying to really see how much slowing is happening in the economy. The economy has performed very well. The labor market has held up very well. Even though there's been a little bit more slowing more recently, that's allowed them to be patient here. So I think the emphasis is going to be on the inflation side still, even though that they are open to the idea of cutting rates if the economy does start to slow quicker than they think. But I think, the guidance going forward isn't probably going to change all that much, that it would really require a rethink on our part. I mean, later in the year, it does get, a little bit more unclear as can they go before an election or will they prefer to go after? Powell has very much emphasized that they will do what's required no matter what the outcome of the election is, or they're an independent central bank, and they will do what's necessary for to get inflation back down to 2% and continue with a strong labor market. It's just a matter of the data and the inflation side. We do think there'll be monthly progress. We've seen very tentative evidence of that in the April data. We'll see the May CPI the morning of the Fed meeting. But I think each time those Q1 inflation data came out, so we got a really strong one in January, a strong one in February, another strong one in March. The bar, so to speak, was reset each time. So, the expectation of can the Fed start cutting rates in the summer, I think is pushing, those disappointing inflation readings gives less confidence that they're going to get back down to 2%. So they just keep pushing out their expectations. So I really don't think that the Fed is, on the cusp of starting to initiate cuts anytime soon. Can it happen in September? Certainly. It'll depend also on the growth side. If the growth side are slowing down, sure, that's a plausible scenario where you could envision they cut in September. But optically, it's a little bit of a challenge, even though the Fed says they're independent from the election. It gives a little bit of a mixed message for a lot of Americans who aren't really paying attention closely to the FOMC, and most don't even know what the FOMC is, about like getting ahead of an election and possibly looking to favor one candidate over the other, as far as like a confusing message of why is the Fed cutting rates. that I would imagine they'd probably want to stay out of the headlines ahead of an election. And I really think that the year-on-year pace on core PCE is going to remain pretty elevated. There's a lot of base effects that keep those numbers pretty elevated. Last year, on a month-to-month basis, we saw a lot of slowing in the second and third quarters, that even if our forecast is right, that we're going to see monthly sequential progress on those core PCE numbers of, say, like averaging 0.2 over the next 5 or so months, those year-on-year comparisons are pretty difficult. So optically, some of the more hawkish members of the committee may be a little bit more reluctant to start an easing cycle, without confirmation that that number is going to get back down to 2%. That, at this time, it still feels like December is probably a safe bet from our perspective, but really it'll come down to the data. And I think that's going to be an emphasis on Powell's press conference, that even if the long run dot were to move up next week, I think he's really going to emphasize data dependence, and they're kind of going at it from a risk management standpoint rather than basing policy on models per se, of where there's a lot of uncertainty about things like trend growth and the long run rate. So that's my expectations for rates right now, if we get something close to what we expect next week.
Lots of data dependence by the sound of it for central banks across the globe, I would say. So that's it for this week's Bondcast. Thank you all for listening, and please do subscribe if you do like this episode. Thanks again, and see you next week.